When a big company invests in another, it's not always just a simple stock buy. A lot of the time, it's about getting a voice, a seat at the table, a level of sway that's, well, just short of outright control. Today, we're going to decode the accounting rules that actually reveal these hidden networks of corporate influence.
So, here's how we're going to break it down. First up, we'll look at the core issue. How do you even account for influence when it's not full control? Then we'll get into the key definition of significant influence. After that, we'll dive into the solution, the equity method. And finally, we'll cover the exceptions, when the rules get bent or don't apply at all. Okay, so picture this. A company makes a really strategic investment in another one. They're not just some passive shareholder anymore. They have a real say in how things are run. But they don't own enough to call all the shots. So the question is, how on earth do you reflect a relationship like that on a balance sheet?
And that is the fundamental question, right? It's the whole reason the accounting standard IAS 28 was created. It's this recognition that some investments carry real weight, real power, and create a direct link to another company's performance that just has to be captured accurately.
Now, to solve this problem, the standard introduces this really crucial concept. It's not about control, it's about something a bit more subtle called significant influence. This is the dividing line. This is the trigger that changes absolutely everything about how an investment gets reported.
So here it is, the official definition. The key phrase here is power to participate. Think of it like this. You don't have the power to write the script for the play, but you've got a seat on the stage and a real say in the performance. You can't control the final outcome, but your voice absolutely has to be heard.
So where is the line drawn? Well, accountants like to start with a number, and that number is 20%. If a company owns 20% or more of another company's voting shares, it's presumed they have significant influence. But listen to that word, presumed. It's a really strong starting point, for sure, but it is not the final word. Because let's be real, influence is about so much more than just a percentage. Even if you own less than 20%, you could still have a huge say. Do you have a seat on their board? Are you involved in making big policy decisions? Are your top managers moving back and forth between the companies? These are the real-world signs of influence that tell the story beyond the numbers. And it gets even more interesting. There's another layer here. The assessment also has to look at potential voting rights. So, if an investor is holding something like convertible shares they could turn into voting shares right now, that potential power gets factored in. It's all about the power you could use today, not just the power you're actually using. Okay, so once you've established that there's significant influence, how do you actually show it on the books? You can't just leave the investment at its original price. That wouldn't tell the real story at all. And this brings us to the specific accounting treatment that's required, the equity method. What the equity method does is create a kind of living link right there on the balance sheet. Instead of being a static, unchanging number, the investment's value now breathes with the other company. It goes up when they make a profit, and it goes down when they take a loss. The way it works is actually pretty straightforward. First, you record the investment at what you paid for it. Simple enough. Then, each reporting period, you adjust that value. If the other company, the associate, made a profit, your investment's value goes up by your share of that profit. And if they paid you a dividend, the value of your investment goes down because, well, that cash is now in your pocket, not sitting in their company. Now, understanding why this whole method is necessary is really the key. And the standard itself tells us why. It says just recording dividends as income isn't good enough. Why? Because a company could be incredibly profitable but decide not to pay out any dividends. The equity method makes sure the investor recognizes the true economic reality, not just the cash they happen to get.
The rules also get pretty specific about deals between the two companies. To stop them from, say, selling assets back and forth just to create fake profits, any gains on these upstream or downstream sales have to be eliminated from the books. It basically keeps the accounting honest until that asset is eventually sold to a real outside party.
But of course, no accounting rule is one size fits all. So for our last section, let's take a look at the situations where the equity method isn't used or when it's time to stop using it altogether. Yeah, there are a few key exemptions. For example, if you're a small subsidiary and your parent company is already rolling all your financials up into one big consolidated report, then doing it again would just be redundant. Also, certain types of companies, like venture capital funds, often have the option to just track their investments at their fair market value instead. So how do you know when it's time to stop? Well, the trigger is actually really simple and logical.
The very moment an investor loses that significant influence, maybe they sold some shares or something else changed, they have to stop using the equity method, starting from that day forward. The whole exit process is laid out really clearly. First, you just stop the method. Then, you reevaluate whatever stake you still have left at its current market price, which is what accountants call fair value. And finally, the difference between the old value you had on your books and this new market value gets recorded as a one-time gain or loss. The relationship has changed, so the accountant has to change right along with it.
So the next time you're scanning a company's balance sheet and you see that line, investment in associate, you'll know it's so much more than just a number. It's a story about a strategic relationship, a web of influence, and a direct link to another company's destiny. So the real question is, now that you know this, how does it change the way you see the entire corporate world?